We just saw a 1,400 point intraday swing in the Dow Jones Industrial Average. What on earth happened in stock markets today? I have seen a lot of people on FinTwit and on YouTube trying to get their head around what we all just witnessed. We had the CPI come in this morning. It was higher than expected, and predictably, the stock market sold off on that. And then the opening bell rang, and up we went nonstop all day. At one point, we were up almost 1,000 points. And I was talking on my live stream this morning after the CPI release that I thought we were going to see 1,000 points down. What just happened? Well, some of the explanations I've seen have been pretty good. Some of them have been pretty accurate. Some of them have been kind of funny. And some are so just god awful that I have to mention them. And with that, we are going to shrink my big melon of a head. And let's see if we can figure out what happened today. First of all, this is looking at the S&P 500. Here is the opening bell. We had CPI came in at 8:30 this morning. It was 8.2% year over year. That was just slightly higher than the market was expecting. And of course, that means a more aggressive Fed. So a more aggressive Fed is considered bad for stocks, bad for the economy. You would think stocks would sell off. That's exactly what happened. We opened down almost 500 points. We went down a little bit lower, but then look, we quickly found a bottom and up we went all day long. And we ended up closing on the day up over 2.5%. That is a wild intraday swing. First of all, shout out to Michael Guyad, who put out this. This is just hilarious. And man, was he right on the money. This was hours ago, right after the opening bell. Cramer relentlessly calling people who bought the futures pre-CPI release outright stupid means we close positive on the day. Now, I'm pretty sure he was kidding when he said that. But man, that inverse Jim Cramer indicator continues to pay dividends. Shout out to Michael Guyad. Nice call there from the lead lag report. Now, I also saw this take, and this one is just so bad, I had to say something. Shout out to the Happy Hawaiian. He's the one who first spotted this. I'm not going to show you this guy's name because I don't want people to go and to beat on the guy on Twitter, but this was a really, really bad take. This guy says, here's how I look at the data. Take core CPI, which is CPI without food and without energy, because we all know people don't need eat and heat, right? But then he also excludes OER, which is owner's equivalent rent. And he says not rent, but just owner's equivalent rent. Then you look at the quarterly change annualized to smooth out month to month for volatility. Okay, so now we're looking at quarter over quarter CPI minus food, minus energy, and minus rent. And there's no denying that there is some serious deceleration in goods and services CPI. Well, this is brilliant. All you had to do was strip out food, strip out energy, strip out shelter, which, it's only about 85% of the average family's after-tax budget. But once you overlook that minor detail, clearly inflation is on its way down. And what this guy is suggesting is this big run-up in stocks we saw today is because inflation is peaking. And all you have to do is get rid of food, energy, rent, and voila, inflation has peaked. This was absolutely the worst take I saw on FinTwit today, but I wanted to include this one just for the entertainment value alone. I also want to send a shout out to Stephen Van Meter. I like Stephen's channel. I watch him all the time, and he says what we saw today could have been HFTs, that's high frequency traders, trolling dip buyers into thinking the bottom is in. And Van Meter might be onto something. This could have been a bull trap today. We could have seen the algorithms driving markets higher just to lure in the bulls, only to resume the sell-off afterwards. Now, I have a theory on one thing that might have contributed to this, and that's this story that came out of the European Central Bank today. ECB staff sees lower rate peak than market sources say. And this came out at 11:30 a.m. this morning, which means the actual news would have broke a few hours beforehand. It takes about 2 hours for them to vet a story and actually take it to print. So the market had time to digest this before it hit Reuters, and that would roughly coincide with the opening bell this morning. European Central Bank staff sees the need for fewer rate hikes than markets now estimate to tame inflation, according to a new internal model that could serve as a key input to future deliberations, 4 sources close to the discussion said. The new model, called Target Consistent Terminal Rate, that's a mouthful, showed the ECB needs to raise its deposit rate to 2.25%, or even less than that, if at the same time they shrink their balance sheet, to bring inflation back to its 2% goal. So let me just say, this is flat on its face wrong. There is nothing even remotely realistic in these projections from the European Central Bank. The idea that all they have to do is raise their policy rate to 2% to get inflation under control, Understand, folks, this reeks of desperation by the ECB. They know they have to pivot soon, and they're just trying to come up with some kind of math, some kind of model that allows them to save face when they do that pivot, because they know they're going to have to print money in order to pay for energy this winter, and that inflation is going to come roaring back when that happens. This is well below the market's estimates for the ECB's deposit rate to peak just over 3%, suggesting the ECB staff consider inflationary pressures more modest than investors and even some central bankers. Senior staff presented the model to policymakers at a retreat in Cyprus this week. Now, this wasn't very well received by the higher-ups at the ECB, so this hasn't been made policy yet, but this does show the direction where they're headed. The staff study suggests that rates would then need to rise only a touch into restrictive territory to get inflation, now at 10%, back to 2% over the medium term. Now, I don't want to understate just how bad this take is at the European Central Bank. They're saying that they think they only need to raise rates to 2%, and that will be enough to bring inflation from 10% back down to 2%. And they're saying this could happen over the next few months, like between now and December. Well, winter arrives between now and December, and the ECB is going to have to start printing euros to pay for their natural gas bill. There is no way hiking to 2% is going to be enough to get inflation from 10% back down to 2%. The only way that happens is an absolute 100% collapse of the entire European economy. Maybe that's what they're saying here. At least that would make a little bit of sense to me. So one possible explanation that I've come up with for why stocks rallied so hard this morning, and the fact that it coincided roughly with this news coming out of the ECB, is this could mean that the ECB pivot is coming very soon, and therefore some investors are thinking maybe the Fed pivot is coming right after that. Again, I'm grabbing at straws here, trying to understand what happened in markets today. This was a very dovish report from the ECB, so that's one possible bullish case for what happened in stocks today. But I also want to mention this article that I saw in Bloomberg, and this sums things up pretty well. Why stocks swung 5% in one day. Stocks are far from screaming bargains after a $15 trillion wipeout. Big reversals are just the nature of the beast these days, Saunders says. And you know what? That last line there, big reversals are the nature of the beast these days. I think that sums it up pretty accurately. Folks, you need to get used to volatility. We're going to see big swings like this in the future. A shock turnaround in equities sent Wall Street searching for something, anything, to explain how yet another red-hot inflation number translated into the best day for bulls in a week. It's the nature of the beast these days where sometimes you get these intraday big swings. We can all speculate on what might be behind it, said Liz Ann Saunders, chief investment strategist for Charles Schwab. A lot of it has to do, for lack of a better word, the mechanics of the market. The fact that there's more shorter-term money in the market, there's more money that moves around based on algorithm, quantitative strategies, and at any point in time, you can have triggers that can cause a 180 in the middle of the day. She's saying this volatility is just part of life now. You have a lot of people are out there going out on margin, taking out these highly leveraged short-term trades, and when they all exit their positions all at once, it can cause big moves in markets that can snowball into these big rapid turnarounds. With calling the direction of stocks a near impossibility, professional traders have been busy limiting their exposure to surprise moves. Institutions bought more than $10 billion in puts on individual stocks last week, a record for that group, and close to the most ever by any cohort of traders, according to Sundial Capital Research. There was circumstantial evidence that those wagers paid off in the immediate aftermath of the government's report on CPI, which showed hotter than expected inflation. While equity futures sold off, the CBO Volatility Index, a gauge of market anxiety tied to options in the S&P, actually fell, potentially a sign of profit-taking by hedged traders. And as those positions were monetized, that prompted market makers to unwind short positions that they had put on to maintain their neutral market stance. So there's a lot of big words in there, and that's a very long-winded answer, but suffice it to say there was so much negativity in markets, and they were right. When the bears started taking profits, it caused this snowballing effect, and it sent stocks a lot higher. Remember, when you cover a short, you're buying, so that puts upward pressure on prices. And you had a lot of people were very short. And so when they all started taking profits, it started this snowball of upward moves. Elsewhere, a clutch of technical signals was on the bull's side, among them a 50% retracement in the 22-month rally that broke out in the S&P 500 in March of 2020. When the index undercut the 3517 level, some market watchers took that as a sign that the 9-month sell-off had gone too far. So So what they're talking about there is we may have found support at the 50% Fibonacci retracement level. All right, Fibonacci, that's based on the golden ratio, something I talked about in the MMMRI video. We're going to draw that right now to show what Bloomberg is talking about. Here is the bottom we hit in March of 2020, and then here is the top we hit earlier this year. And if you notice, we bounced right around the 50% level today. You see this line right here, right about the 50% level. We got down below that. We bounced hard and closed highly above it. That is a level where typically you find strong support, a 50% retracement of a big move like that. So that's one possible technical explanation for what happened today. We had a 50% retracement. We finally sold off to a level that was roughly halfway between the low of March of 2020 and the high we hit at the beginning of this year. And typically a 50% retracement level, you do find a little bit of technical support there. So that's one possible technical reason why we caught a bounce. Now back to the Bloomberg article here, they're saying another buffer came in at the index's 200-week average, a threshold that hovers around the 3,600 level and has become a battle line for bulls and bears in recent weeks. And you can see that on this chart, this purple line here, this is the 200-week moving average. And if you zoom in on the chart, you can see we dipped just below that one for a little while today, only to bounce back up. So look, folks, take your pick. There's a lot of explanations are out there being offered up for what we saw today. Maybe it was Stephen Van Meter's bull trap. Maybe it was the inverse Jim Cramer move, like Michael Guy had said. Or maybe it was that other guy's idea that if you strip out paltry little details like food, energy, and rent, all of a sudden inflation doesn't look so bad. Or it could have been that report from the ECB indicating that their pivot is coming. It could have been the mechanics of the market, the shorts covering. It could have been these technical indicators, the 50% Fibonacci retracement or the 200-day moving average. There's a whole myriad of reasons being offered up for what happened in the markets today. So instead of me trying to pick one, I'm just going to take the lesson here. And what the market is telling me is, Jack, don't go out on leverage. Don't borrow money to bet on the direction of the stock market. Don't take out short duration options where you might get stop lossed out. That's too risky in an environment where the market could swing plus or minus 1,000 points in any given day. My personal opinion, this is not the bottom. I think we are going much, much lower. But we could see these big positive swings, these little bear market rallies on the way down. We'll probably get this again. Get used to volatility, folks. For whatever reason, volatility is here to stay. These markets are starting to break down. They're starting to have a lot of stress. And these big price moves are going to happen. We could wake up tomorrow morning to see futures are down 1,000 points just as fast, or we could see they're up another 1,000 points. As always, guys, I have to remind you I'm not a financial advisor, and this isn't financial advice. This is just me talking about what I'm doing with my money and commenting on what I see in markets. So what do you guys think caused this big rally today, this big intraday swing? Let me know down in the comments. I will pin either the best explanation or the most hilarious worst explanation for what happened in markets today. Let's see what you guys can come up with down below. Until next time, live small and dream big.